very good day once again. Back to our class, back to investments, back to portfolio management, back to talk about futures. When we're talking about investments, we're talking about investing for the future. When talking about management, we're talking about managing our investments for the future. Last time we had discussed the last stage of the top-down approach in EIC, and that was a focus on company analysis. And in focusing on a company analysis, we were looking at the intrinsic value of a company. When we're talking about intrinsic value of a company, we're talking about justifying our investment decision, justifying whether the value is right or wrong. We need to know about the inherent strength of the company, and we need to know whether we're paying good money for a good company or good money for a bad company. That is what intrinsic valuation is all about. Inherent strength. तभी तो company grow करेगी, तभी तो आपकी investment grow करेगी, because your investment is hedged with the company. Obviously, if a company grows, your money will grow with it. We talked about earning multiples and the significance of earnings per share and whether a stock is undervalued or underpriced or whether a share is overvalued or overpriced. But if the value of a stock is intrinsically strong, you can buy the share focusing also on the price earning issue, focusing also on the capacity of the company to pay dividends, focusing on the issue that there is a close relationship on payout and the price of a stock. This is important because earnings होंगी तो stock की price improve होगी, earnings कम होंगी तो price naturally they will go down as well. Now, ये बात हम कर रहे थे intrinsic value की. जब हम intrinsic value की बात करते हैं तो हमें ये भी पता होना चाहिए कि ये हम इन्वेस्टमेंट्स के हवाले से जब बात करते हैं तो हम फाइनेंशियल स्टेटमेंट्स को भी देखते हैं. जब फाइनेंशियल स्टेटमेंट्स की बात होती है, वी नो that it provides financial information. The analysis implies comparison over time or with other companies in the same sector. Once again, the focus is not on how statements have been used or made. The important thing is your ability to be able to take the best advantage of the statement. Now, statements carry between the lines information. Statements carry notes to its statements. So we must understand using these materials available as well. Now, basic financial statement would cover up a balance sheet, and there are items listed in order of liability and the liquidity aspect, the asset aspect are included. The assets will have cash assets and non-cash assets. Now, in non-cash assets, there is ambiguity whether they'll be valued more at the time of sale or valued less when they were carried on the books. Assets will also contain information on depreciation methodologies for fixed assets. And there is going to be change in evaluation methodologies on the inventory available with the company. These are all variables as far as non-cash assets are concerned. We'll also be looking at the liability aspect of a balance sheet and what are the fixed claims against a company. So, we need to understand what the income statement is linked to the liabilities. Because we have assets, we have liabilities. What is coming into the company and what is going to go out of the company. So this is linked to the income statement. Now I can assure you this is the picture of a financial statement of a company at one point of time, at one given time. Because there is going to be end date to a financial statement. The end date will be the end of the financial year, which probably will be June. So these figures are going to be taken at a cutoff date to be evaluated. Now, the important thing is that we must weigh the earning per share potential in the financial statement. You must understand what the earning per share is. There is no need greater than me to emphasize on the value and potential of earning per share. And once again, earning per share is the net income over the outstanding number of common shares available. That only will tell you the potential of the company's earning capacities. Then we must also talk a little bit about auditors and auditing the statements. Auditors, I may remind you, do not guarantee the accuracy of the statement, the accuracy of the earnings, but only that statements are fair financial representation of the company. We're not talking about earnings. They've got no likelihood to be able to be, verifying the earnings of a share. There are problems related with the earnings, and earnings can be a bit of a question mark as far as how the true performance is being evaluated. So you need to compare these values with other companies to be able to understand the potential of the earnings. There are different methodologies. We have the generally accepted accounting principles. We have the international auditing methodologies, but we have variables and we have different ways of taking a balance. Sometimes earnings per share can become a bone of contention for different security analysts. So it is a difficult task to actually truly evaluate the performance of a company. Now, we must analyze whether a company is growing as far as earning is concerned or whether a company is not. Because we did mention stock prices have the ability to correlate itself with the earning potential of a company. Return on equity. Return on equity is another important aspect to be based your investment decision on. So it is a key component in finding earnings and dividend growth. You cannot overlook earning per share. You cannot overlook return on equity, which I'll be just letting you know more about in a little while. But three things should be inbuilt, should be ingrained in your abilities to discuss things and evaluate companies is earning per share, return on equity, and price earning ratio. We talked at length about the Dupont analysis and that the share prices being dependent partly on the return on equity and the ability of the management to influence the return on equity and the decomposing return on equity into its component that analysts find difficult to identify with the future trends. The Dupont analysis highlights expense control, it highlights asset allocation and debt utilization. The asset utilization and debt utilization are also highlighted in the Dupont analysis and are ingrained or inbuilt into evaluating a company. So the significance lies in being able to find out the key aspects of the Dupont analysis as a methodology to understand these things. So we talked about profit on margins, which would mean earnings before interest and taxes divided by sales. We talked about total asset turnover, which would have been sales divided by the total assets. We talked about interest burden, which would mean the pre-tax income divided by earnings before interest and taxes. We actually talked about tax burden based on the tax levels as well. We talked about the leverage of the company. We talked about financial leverage. And then that large ratio that I mentioned was the return on equity was based on earnings before interest and taxes, efficiency multiplied by asset turnover, multiplied by interest burden, multiplied by tax burden, multiplied by leverage. Now, expected earning per share is of the most paramount value in evaluating a company. The idea was that the stock price is a function of future earnings and PE ratios. We talked about investors trying to hit the estimate right about the growth in dividends or earnings. Then we talked about estimating internal growth. जाहिर है जब हमने intrinsic value की बात की तो हमने बात की थी कि internal strength भी एक company की होनी चाहिए. So when we talked about internal strength, we talked about intrinsic values. When we talked about intrinsic values, we talked about the worth of a company based on its fundamental values. Now, the important thing again is that we must understand the value of a company based on the return on equity. The most important thing is, I mentioned that the estimates are dependent on the data period and only reliable if growth is constant and stable. But please keep in mind, what matters is future growth. It's not the historical growth rate. Of course, historical growth rates will impact future growth rates, but the focus has to be on the future. You're investing for the future. We cannot overlook historical data, but we must understand that we have to have a bigger vision for future. Now, while we're talking about forecasting earning per share, we must understand that analysts may be wrong at times, because evidence does favor sometimes that the analysts would have an edge over statistical models, because predicting what actually is reported, the earnings will be different. So, we do use historical data in forecasting the future, but the key components of forecasting are intuition, perception, clear vision, your ability to preempt change, your ability to look and read between the lines from the balance sheet made available to you and find out how significantly can the historical growth rate impact future growth rate. So, stock prices are affected by level and growth in earnings, plus market expectations of earnings. The important thing is that markets expect companies to perform even better than last year. If they do not, there is a substantial reduction in stock prices. So sometimes you'll have unexpected information available to you for revising earnings per share. Sometimes you'll have one-time specialized earning done through sale of non-cash assets. So these informations, when incorporated into the earning potential, will result in significantly enhanced earning per share. They will also impact your ability to decide whether to invest in the company or not. Earnings surprisingly matter a lot while deciding what price to pay. So there are revisions made into the estimates. Stocks with revisions of 5% or more on the upside or the downside show above or below average performance. So there has got to be a correlation with revising estimates. So you can't just make calculated guesses. Your estimates should be almost be precise. These revisions will help you make a newer dimensional approach towards the company, but generally speaking, these revisions may also confuse investors and analysts alike. So if we were to stick to a stable, constant growth analytical model, we'll be better off in predicting what the future lies and what the future holds in the company. Now, since we've been talking about the earning per share and the return on equity and the price earning ratios in quite a substantively detailed format, we must understand the ability of the investors to evaluate the potential of the company's ability to grow. More importantly, we must more significantly understand the values of the price earning ratios. We talked about so many liquidity ratios, so many leverage ratios, so many profitability ratios that the mind just, goes confused. But price earning ratios and price earning multiples carry significant weightage in this aspect. Now, this measures how an investor evaluates a company's future. What is an investor currently willing to pay for the company, looking at its earning potential? So, a relative price measure of a stock is claimed by the price earning multiple, because that tells you more about the price measure of a stock and its potential to grow. Now, basically, the price earning ratio is a function of expected dividend payout ratio, the required rate of return, and the expected growth rate in dividends. It is an amalgamation of these things, all based on future expected earnings payout ratio, future growth in dividends, and the required rate of return is what makes up the price earning ratio, and becomes significantly more important. We talked about low PE ratios and high PE ratios. We talked that companies with the potential to grow would have a high price earning ratio because of the investors' confidence in the company and the confidence in the expectation of the company to grow in future, which does not undermine a single-digit price earning multiple, because price earning multiples do actually also tell you the number of years it is going to take for you to recover your monies invested based on the dividend yields you will be getting. Generally speaking, here in this region we have a 10 to 15 price earning multiple, which would mean that you'd be able to find it as a benchmark of looking at whether you have companies with a higher price earning multiple or a low price earning multiple in relationship to the generalized price earning multiple of the industry and the price earning multiple of the exchange. All regions have different multiples, but we must understand what we are getting into. So, we must understand the other partner in the price earning ratio is the dividend payout, the capacity of the company to pay out. Now, the dividends usually are maintained but are decreased only if no other alternative is available. You try to maintain a stable payout ratio. They're not increased at all on the basis of the supported levels of income. They're adjusted with a lag to earnings. Dividends do not necessarily have to be completely in line with earnings. These are two different things. Earning per share is very different from a dividend per share. Now, the higher the expected payout ratio, the higher the PE ratio. If you think the company will pay out more, then the price earning ratio will also be more, because remember, price earning ratio is replicating your ideas about the future of a company. Growth rates will probably decline, adversely affecting P ratios, which will then come down. Price earning ratios replicate your confidence in a company. So higher P ratios will tell that you are really confident about the company's future. So dividend payout ratios have to be adjusted with the expected PE ratios. So higher the dividend payout expectations, higher the price earning ratios. Now, dividend payout ratios are different from earning payout ratios. Now, earning per share के ऊपर बेस करेंगे dividend payout. Obviously, you cannot pay out more dividends than you have earned. So obviously, earnings shall be greater than dividends. You may pay out 100% of the earnings you've had, you may pay a part of it. It all depend on the policies of the manager. How much money they will want to retain into their reserves and how much they're willing to pay out. We did talk about dividends being paid out from current income, which meant since we're paying out the dividend from the current income, you would have lesser money available to you as working capital and lesser money available to you to take into the retained earnings aspect. It will reduce the funds available to the company. Naturally, when we're talking about earnings, we're talking about returns, we're talking about price, and we cannot ignore the required rate of return. What is actually the required rate of return will vary from one investor to another. But generally, expectations are on the above inflation rate, higher than the normal interest rates. So a function of riskless rate and risk premium has to be looked at. So the required rate of return is the riskless rate and risk premium, which would mean that there has to be a constant growth version of dividend discount model. When we're talking about the Gordon's dividend discount model, we talked about constant growth in the earning potential and the dividend paying capacity. The constant growth version of the dividend discount model can be rearranged so that growth forecasts are readily available based on the function of a riskless rate and risk premium, because then only you are in a position to understand the required rate of return. We also must understand that the risk premium or stock or a composite of business, financial or other risk is the required rate of return. Now, if the risk premium falls, then required rate of return will fall. If the risk premium rises, required rate of return will also rise. If the risk factor or rate of risk rises, then rate of return will also rise and fall vice versa. Now, the discount rates and price earning ratios move inversely to each other. They have a correlation of taking into account the discount rate. So the important thing for us to understand is that the rises in risk premium, the rising in riskless rate of returns are all correlated with each other for us to be understanding the return and the required rate of return. Which brings us to the expected growth rate. How are we able to understand the expected growth rate, which is a function of return on equity, ROE? We previously had discussed that the return on equity is a function of expected growth rate and dividends. Because we are talking about the future, so we expect everything from dividends, from future growth rates, from price earning ratios. There are multiple expectations based on the future growth. The higher the growth rate, the higher the price earning ratio. Naturally, since price earning ratios do depict the future potential of the company to earn, naturally then the expected growth rate would expect to be higher in relation to a higher price earning ratio as well. Price earning ratio depends on confidence that investors have in expected growth of the future of a company, and these are the reasons for earnings growth. Because investor confidence develops on price earning multiples, and the ability of the company's potentially expected earning potential will be reflected in the price earning higher multiple and higher stock price because they're all correlated. So the future has to be anticipated on the basis of a higher dividend payout ratio, higher expected growth rate, and higher price earning ratio. Now, regardless of details and complexities of analyzing companies, the analysts and investors seek a middle of the line way. They seek an estimate of earnings and a justified price earning multiple to determine the internal strength of a company, to determine the intrinsic value of the company. And then they are able to decide what sort of company can be invested in. Because security analysis always involves predicting the future, predicting the uncertain future, and also analyzing mistakes that will be made, and obviously then outlooks will differ. But analysts will try to make best use of financial statements and try to make the best estimates into envisioning what the expected growth rate can be, the future dividend payout ratio in relation to the growth rate and the price earning ratio and the required rate of return, which keep changing with the outlook of the investor and outlook of the security analyst. It is actually, I would not be inappropriate in saying that this is the barometer of the confidence of the investor and an analyst in a company's future earning potential, provided they get the right figures in the dividend payout ratios, right figures in expected price earning multiples, and expected growth rates. These all help in analyzing stocks. Remember, we are at the last stage of the top-down approach and focusing on companies and looking at the balance sheets and the financial statements of a company. We had previously talked about ratios in detail. Here we are only talking about ratios with words applied with them like PE ratios, dividend payout ratios, and the expected growth rate, which will be discussed in detail while we're talking about the overview of financial statements. Now, while we're talking about the overview of financial statements, we are generally referring to three basic components, and that is the balance sheet, the income statement, the statement of cash flows. Sometimes, but not always, people include another statement as the fourth component called the statement of retained earnings. But what we will focus on, the balance sheet, the income statement, and the statement of cash flows. Now, what is a balance sheet? A balance sheet lists a lot of things, and the two most important of them are the assets and the liabilities. Now, balance sheets contain vital information. They highlight the financial condition of a company. Balance sheets highlight the health of a company once again at a single given point of time. Balance sheet, while studying them, it is important that the cash flow and income statements record performance over a period of time. And while the balance sheet is just a snapshot of the entire picture at given point of time. So balance sheet lists all the assets held by the company in addition to the portion of assets that are financed by debt, which would mean liabilities. You may not be a company that's having all its business done through 100% equity base. So you need leverage, you need debt, so there will be liabilities. And there will be equity. That will be what? That will be the shares that have been issued along with reserves or retained earnings. So in a balance sheet, we're talking about assets, we're talking about liabilities, and we are talking about equity. At any given point of time, there'll be returned earnings or reserves along with the paid up capital subscribed by the promoters of the company and the stakeholders or the shareholders or the investors of the company, which makes up the equity of the company. So, while the balance sheet highlights the financial condition of a company at any one given point of time, it also tells you about the cash flow positions and it lists all the assets, all the liabilities or debts, and the equity. These three things are paramount while we are talking about the balance sheet. Retained earnings are focal. Retained earnings strengthen a company's base. Retained earnings are the ability of the company to withstand any eventuality happening with the company. So, these three things, these statements of retained earnings or retained earnings and reserves, equity and assets and liabilities are the key in a balance sheet. Now, coming to income statements, obviously, as the word implies, anything that's coming in is income. So, income is welcome. In income statement, we know through the balance sheet, which tells us how much money a company is brought in as revenue. आमदन कितनी है, revenues कितने आ रहे हैं कंपनी, पैसा आ कितना रहा है अंदर, how much is it spending, the expense में बहुत सारे heads हैं, मैनेजमेंट भी हो सकता है, वो प्रोडक्शन भी हो सकती हैं, वो ऑपरेशनल भी हो सकती हैं, वो इंटरेस्ट पेमेंट्स भी हो सकती हैं. So, the income statement tells about the income and revenues and the expenditures and the difference between the two, the profit or the loss over a specified term. Let's assume 1 year. अगर तो जाहिर है इनकम ज़्यादा है, एक्सपेंडिचर्स कम है तो प्रॉफिट है, और अगर एक्सपेंसेस ज़्यादा है, इनकम कम है तो लॉस है. Very understandable. They include, the income statement includes figures such as revenue, 1, net income, 2, and the earning per share. So, net income, earnings per share, and the revenue are the figures that are included in the income statement. An income statement is something on which you can dwell upon in looking at the three basic figures and then trying to understand whether the company has spent more, earned less, or earned more and spent less, which would be the basis of finding out whether there is an earning per share or a loss per share. Obviously, we are not interested in companies which are making losses. We might be looking at companies making losses with the potential to turn around. Now, this is what we've talked about in the income statement. Then there was another component of the balance sheet called the statement of cash flows. Now, the statement of cash flow is similar to the income statement. The cash flows, however, are different in a way that the income statement also takes into account some non-cash accounting items such as depreciation. A difference between a cash flow statement and income statement lies here, because in an income statement you are able to understand the values of depreciation and its impact on the overall balance sheet. But the cash flow statement doesn't take into account all this. The cash flow statement strips away all this, it does away all with this depreciation and tells you how much actually has been earned or how much revenues has the company generated. It is more focused on now. The income statement is more focused on everything. So cash flow will tell you right now what has been brought in. So cash flow shows us how the company has performed. It shows us how the company is managing inflows and outflows. It shows us a sharper picture of the company's ability to pay creditors, and to finance its growth. It does away with all that has to be eventually taken care of, but is more focused on what's happening now. What has the company earned through its business, and tells us how a company is managing its funds, how a company is managing its income, inflow, expenditure, or outflow, and also tells us a lot about the company's ability to pay off its debts, to pay off its bills, and also to finance the growth aspect of a company. Now, we've just talked about the income statement and the cash flow statement, and the difference between the income statement and cash flow statement. Now, while we're understanding financial statements, we're obviously also trying to understand the balance sheet. This is all about valuation of the company. While we're understanding balance sheet, we must understand it is one of the most important financial statements. It is reported to investors because of good corporate governance, because of better regulations of the capital markets. We have more information coming into for the investors. So instead of just having one annual report printed after every 12 months, we now have semi-annual reports, and we have quarterly reports every 6 months and every year. So you've got more information. So now you have a 3-monthly quarterly report, a biannual report, a 9-month report, and a 12-month annual report. More information coming into the investors to find out about balance sheet. So once again, a balance sheet provides you information on what the company owns and what the company owes. The N and the E makes the difference. OWN own and OWE. What you own, what are the assets, what you owe, what are the liabilities, and what is the value of the business and its stockholders, which is the equity and the reserves. You, through this statement, come to know how much the company owns, how much the company owes, and what do you understand about the equity as being the stake in a company. So these are things that you understand from the balance sheet, and then are able to evaluate the strength of the company. Now, around this part, we are able to understand that these things need to be assessed minutely to know how much net difference is available to you in terms of assets and liabilities, and whether the assets and liabilities are in relationship to past historical data available. That is what you need to understand. That is why a balance sheet is important. That is why it is called the fundamental report on a company's possession. It is the fundamental document on the company's possessions, the company's debts, and the capital invested in the company, the equity. That is the fundamental aspect or the fundamental picture shown through a balance sheet. So, before investing in any company, before we even think of investing, an investor can use the balance sheet to examine several things. Remember, before you invest, not after you regret. Before you invest, you can find a lot of things to examine in the balance sheet. You can maybe examine a fact that can the firm meet its financial obligations? Does it have enough money to pay out its liabilities? Does it have any reserves? You can maybe think about how much money has already been invested in the company. You can think, is the company overly indebted? Too much debt with the company? Too much leverage? What kind of assets has the company purchased with its finance? What has it done with the money it's borrowed? Has it actually added value to the company through the leverage financing or the debt that it's acquired? Because you're going to be paying for it through the profits that are being paid in the company. So wasteful expenditure has to be noticed. Flamboyant living of the management has to be noted. Extravagant affairs of the companies have to be noticed. Is the money being spent well? Is the money worth the interest that the company is going to pay on it? Is it sensible? Has the assets that have been acquired evaluated properly, or are they evaluated overtly? Now, these are things that are needing to be evaluated by the investors. These are things that we need to focus on before investing into a company. There is a basic concept behind a balance sheet and how it is formed. There is a basis on what a balance sheet is. So, in order to acquire assets, a firm must pay for them. Naturally, whatever you are going to buy, you have to pay for it. Whatever a company wants to acquire as assets, a firm must pay for them with either debt, which is a liability, or with the owner's capital, which is the shareholder's equity. So you pay it through cash or you pay it through debt. Whatever way you pay, you have to make arrangements for the balance sheet to be made understandable to investors. Assets are going to be liabilities plus shareholders' equity. So maybe at a given stage, if you look at the slide, you'll be able to look at assets equal to liabilities plus shareholders' equities. And the example that is given here, that the total liabilities are 30,000, shareholders' equity is 50,000, so the total assets will be 80,000. Obviously, we don't have to bother much about the 30,000. We should be concerned about the 30,000 because that is a borrowed asset. And then we have to pay back the asset and maybe some charges on the principal amount that's been borrowed. But since the major chunk of the asset is owned through the investments made through the shareholders' equity, it would mean that the company is not borrowing much from outside and is in a position to finance the major portion of an asset. So assets could be liabilities plus shareholders' equity. Now, when we're talking about assets, we are talking actually about the items in a balance sheet. We're talking about current assets. Now, current assets are assets that can be converted into cash within 1 year. That would fall under the domain of current assets. जल्दी जिसकी हम सेलेबिलिटी करके कैश रिसीव कर सकते हैं. Now, generally, better than this is cash. And cash is the most basic current asset. In addition to currency, bank accounts, without restrictions, checks and drafts are also considered cash. Pay orders, checks, drafts, they're all considered as cash because they're immediately payable. And when we're talking about current assets, we're talking about current quick liquidity. So the ease with which we can turn over our checks or pay out of the bank drafts into cash from one instrument to currency can be considered cash, and it's a current asset. Now, there are also things called cash equivalents, are not cash, but can be converted to cash easily and are considered equal to cash. Cash equivalents are generally highly liquid. They're short-term investments, and short-term investments such as government short-term securities and money market funds. The capital market is for long-term investments. The money market is for short-term investments, and that is why it's being referred कि money market funds में अगर आपने पैसा लगाया है तो cash consider किया जाएगा. Why? Because it is cashable within 1 year. So even if your money is into the money market or into short-term government securities, these are all highly liquid and are considered cash equivalents. कैश के बारे में तो मैं पहले आपको बता ही चुका हूँ, या तो हार्ड कैश है, या बेरर चेक है, या ड्राफ्ट है, या पे ऑर्डर है. ये सारे कैश इक्विवेलेंट्स हैं क्योंकि ईजिली कैशेबल हैं, ईजिली convertible into currency. One of the major items in the balance sheet was assets. The other was liabilities. And still another was the equity. इस वक्त हम बात कर रहे हैं assets की, और अभी मैंने आपसे बात की current assets. और current assets में मैंने आपसे बात की थी cash की, और cash के साथ मैंने बात की थी cash equivalents की. दूसरी जो चीज़ मैंने आपसे करंट एसेट्स में अब बात करनी है वो अकाउंट्स रिसीवेबल्स हैं और इन्वेंटरी. ये दो चीज़ें. नाउ अकाउंट्स रिसीवेबल आर व्हाट? रिप्रेजेंटिंग मनी कस्टमर्स ओ द फर्म. ये आने हैं पैसे. एज मोर एंड मोर बिजनेस इज बीइंग डन टुडे, देयर इज मोर आउटस्टैंडिंग डेट एंड रिसीवेबल्स विद क्रेडिट being considered, if of short-term duration, to be considered cash. So credit instead of cash is also a mode of doing business. because सारा आप 100% cash पे काम नहीं कर सकते. So credit पे भी आपको काम, but these are all short-term credits, and this item is of a significant component in the balance sheet. ये तो बात होगी अकाउंट रिसीवेबल की. Now आखिरी चीज़ जो मैं आपसे बात मैं करना चाह रहा हूँ वो मैं बात करना चाह रहा हूँ इन्वेंट्री की. This is the last thing that I need to talk to you about, the inventory. The inventory is the stock of materials used to manufacture their products and the products themselves before they are sold. So a manufacturing entity will often have three types of inventories: raw material, work in progress, and finished goods. So a retail firm's inventory generally will consist only of products purchased that have not been sold yet. ये मैंने इन्वेंट्री की बात करनी थी आपसे. अकाउंट रिसीवेबल्स की बात मैंने आपसे कर ली, एसेट्स में कैश की बात कर ली, और कैश इक्विवेलेंट्स की बात कर ली. दिस कवर अप आर एसेट्स पार्ट ऑफ द बैलेंस शीट. बाकी बैलेंस शीट की बातें इंशाल्लाह आइंदा लेक्चर में करेंगे. तो until then, it's खुदा हाफिज़ फ्रॉम मी.